Believe it or not, my first mortgage was an ARM, an adjustable rate mortgage. I want to tell you all about my experience with my ARM, and I also want to tell you the pros and cons of adjustable rate mortgages. I'm Shaheedah Hill, getting you over the hill to home ownership and helping you confidently buy your first home. Let's talk all about ARM. So the year was 2003, so a while ago. And I was buying my first house and I was offered an ARM. And the way ARMs work, they're fixed for the set term that you're buying. So if you're getting a 3-year ARM, the interest rate is going to be set for the first 3 years, 5-year ARMs, first 5 years, 7-year ARM, first 7 years, and a 10-year ARM. So these are adjustable rate mortgages. After the initial term, the initial fixed term, then the interest rate adjusts, and it adjusts based on a national index. Depending on what that index is, your mortgage could go down, but more than likely it's going to go up based on that index. So adjustable rate mortgages do help you save money initially. So if you're in comparison to a 30-year mortgage, you may be able to save like a 0.5%, if not a full percent or more, the shorter your fixed rate term is. So a 3-year ARM would be, your interest rate would be lower than a 5-year, than a 7-year, than a 10-year. And in my experience, then I had to really think back to say, okay, how was my ARM? Why did I make that decision? And I think it was just to, number one, I knew I wasn't going to be in the house that long. I didn't know exactly how long I was going to be in the house, but I thought at the time, my boyfriend, now husband, I thought we would get married pretty soon. So I figured we would sell the house, get a new house, have kids, all that kind of stuff. So it was really like my first house, kind of my starter home. It wasn't something that I saw myself in for a long term. And I didn't do a 3-year ARM because I wasn't sure how that timeline would go, and I didn't do a 5-year because, again, I'm generally a conservative person by nature. So the 7-year ARM seemed the safest to me, and I think interest rates were in about the 5s or so back then, and I was able to save almost, I think, either a 0.5% or 0.75% or something significant enough that I was willing to do the ARM over the 30-year mortgage. Now, let's talk about the pros and cons of of ARMs, and I want to tell you how my ARM ended up. All right, so ARMs, the benefit of a fixed rate mortgage is that it is fixed for the life of your loan. So you don't have to worry about your mortgage payment, at least principal and interest, going up. Whatever your interest rate is generally fixed for the life of the loan. So that's really the benefit, the stability of having a 30-year mortgage or a 15-year fixed mortgage. They're fixed for the life of the loan. Now, with ARMs, they're going to adjust. So after that initial period, so in my example, after the 7 years, it was going to adjust with a national index. There was a chance that based on that index, the interest rate would go down, but more than likely, your interest rate is going to increase with an ARM after the initial fixed rate. Now, let's talk about other than the interest rate being lower. That's the main advantage. The main pro of an ARM is that your interest rate is going to be lower, and that is going to lead to making your payments over that time period more affordable than it would be in a 30-year loan. Okay, so that's why I did it at the time, because I knew that I wasn't going to be there that long. I also knew that, that was going to save me money. So that's why I did an ARM, and that's why most people do ARMs. They have to know 2 things for sure: that they're not going to be in the house more than that set amount of time before it adjusts, and they're going to pay off the house before the interest rate adjusts. And they also know that, they want to save some money in the short term at least. All right, let's go over the cons to adjustable rate mortgages. The biggest con to adjustable rate mortgages are that the payment is going to increase more than likely. So the con is not having the stability of your payment when that initial period ends. So when that initial period ends, you are kind of uncertain as to what your payment is going to be. Now, there is a lot of talk, I think a lot of comments, I talked about this a little bit in another video that I did, that, this is what happened to the housing crisis in 2008, 2009. Now, there were other products as well. They weren't just ARMs. They were interest-only mortgages. They were like 1-year interest only, and then after that, it went up. So those types of mortgages were in the market. Plus, they made it a lot easier to buy a house back then. I was at the time financially stable, had a pretty good job. My credit score was like the high 700s, 779 to be exact, because I remember those numbers when I was buying my first house. So everything was fine then. I really just did it to save money, during that initial payment. Now, so that the major con again is that your payment will change. So if you are doing this, so say you're doing the lowest one that you can do, and I'm not sure if even 3 year, 5, 7, and 10 are the most common. But some lenders may offer you a 1 year or 2 year, but those are the most common. You have to know that your payment is going to change after that initial period. And if your income remains the same, or you lose you have less income, that's going to be a problem if you cannot afford the house at that higher interest rate. And that's going to be at risk. And a lot of people will say, well, by then you could sell the house or you could refinance. Now, if we are in a volatile market where prices may be going down, prices may not be being as steady, you may have not paid off enough that you'll break even when it's time for you to sell. So you may be selling at a loss. That's number one. And then number two, the refinance, you don't know what interest rates are going to be during that refinance period. So what if interest rates are higher and you still cannot afford it? Or maybe that your income has changed and you can't even qualify for a refinance. Those are some of the things you have to think about when lenders are saying, well, you can just refinance it. You might sell the house by then. So you have to definitely think about everything that could happen when you're doing this, you're doing an adjustable rate mortgage, because there isn't going to be a time, if you stay past that initial period, that you'll have to make some decisions. And you don't want to get into a circumstance in which you cannot afford the payment, or you're not prepared for the payment increasing over time. And it won't just be one increase, it could be multiple increases. Now, with adjustable rate mortgages, there's typically a cap to the amount, like how much it can increase from time to time, or when they can make adjustments. So if you're considering an adjustable rate mortgage, you want to talk to your lender, make them, show it to you in the documents as to how the mortgage interest rate can change, how often it can change, and what's the maximum it could change to. So if you're at 5%, for example, or 4%, can it go up to 10% or 8%? You need to know what is the cap and how many adjustments can be made over the life of the loan. You want to make sure you're having those conversations. You also want to make sure that there are no prepayment penalties on the loan. So you want to, those have been less common, in some of these, since the financial crisis and all those foreclosures. Prepayment penalties are less common, but you never know. You want to make sure, you want to ask, does this loan have a prepayment penalty? If I pay this off earlier, will I be penalized for that? So, and make sure you understand, because ARMs can be a little bit complicated. So you don't want to get into anything ever that you don't understand. So you want to make sure you can completely understand your adjustable rate mortgage. Now let me tell you how my adjustable rate mortgage ended. So I did sell the house. I got engaged maybe a year and a half after I bought the house, and we got engaged. We planned on, selling that house within a year after we got married, that sort of thing. So we sold the house after 3 years. So 3 years of the 7-year ARM, sold the house. I was able to sell the house at a profit, made about $30,000 due to just, making payments and equity increasing. And that was it. So I didn't really have any financial loss from the ARM. I got out of it, in a good amount of time. One of the disadvantages going back, me thinking about it, is if I wanted to keep that property as a rental property, then I didn't have that fixed rate. I would have to refinance it to make sure over the long term that it was going to be a steady, mortgage payment. So that's another con that you want to think about. If you were thinking about keeping that property, even if you did move, then you're still like in your payments could be not stable at that point. So I hope this was helpful to you. I want you to watch my video about interest rates increasing. If you are in that, if you're under contract, there are going to be several interest rate hikes by the Fed in 2022, and you need to be prepared. So please watch that video next. And if you have any questions about ARMs, please put them in the comments. Thank you so much for watching. Please like and subscribe to my channel for new videos every week.